All right, let's talk about investing. You've probably heard the terms mutual fund and ETF thrown around a lot. People talk about them like they're the secret to getting rich. And honestly, they can be amazing tools for building wealth over time. But what are they really? Think of them like big baskets of investments. Instead of you having to go out and buy individual stocks, like one share of Apple, one share of Tesla, and one share of Amazon, you can buy a single thing that holds all of them for you. It's a way to instantly diversify your money across many different companies without needing a ton of cash or spending all day researching. This is super important for beginners because it spreads out your risk. So, let's break it down even simpler. A mutual fund is a professionally managed collection of stocks, bonds, or other assets. A fund manager, a real person or a team of people, makes all the decisions about what to buy and sell inside that fund. They are actively trying to beat the market and get you the best returns possible. On the other side, you have ETFs, which stands for Exchange Traded Funds. These are also baskets of investments, but they typically work a little differently. Most ETFs are designed to passively track a market index, like the S&P 500. This means they just buy and hold whatever is in that index without a manager making active choices. The main idea behind both is diversification. If you put all your money into just one company's stock and that company has a bad year, you could lose a lot. But if your money is spread across 500 companies in a fund, one company having a bad year won't hurt your overall portfolio nearly as much. It's the classic saying, don't put all your eggs in one basket. Both mutual funds and ETFs are fantastic baskets. They just have different ways of being managed, different costs, and different ways you can buy and sell them throughout the day, which we'll get into. So the big picture is this. Both are pools of money for many investors used to buy a wide variety of securities. This gives you, the small investor, access to a professionally managed and diversified portfolio at a very low entry cost. You don't need millions of dollars to own a piece of the entire stock market. You can start with as little as a few dollars in some cases. The key difference really boils down to how they are managed and how they are traded. Understanding these differences is what will help you decide which one is the right starting point for your own investment journey. It's not as complicated as it sounds, I promise. Let's get into the mechanics. How do mutual funds actually work? When you invest in a mutual fund, you are buying shares directly from the fund company. The price of these shares is calculated only once per day after the stock market closes. This price is called the net asset value, or NAV. So, if you place an order to buy a mutual fund at 10 a.m., your order doesn't actually go through until after 4 p.m. Eastern Time when the market closes and the new price is set. You won't know the exact price you paid until the end of the day. It's a bit like ordering something online and getting the final price confirmation at the end of the business day. Now, let's look at ETFs. ETFs trade on a stock exchange just like individual stocks. This is a huge difference. You can buy and sell shares of an ETF at any time during the trading day, from the opening bell to the closing bell. The price of an ETF changes constantly throughout the day, reflecting the real-time value of the assets it holds. This gives you a lot more flexibility. If you see the market dipping and think it's a good time to buy, you can place an order for an ETF right then and there and lock in that price. You have more control over the exact price you pay, which is a feature many investors really appreciate. Think of it this way. Buying a mutual fund is like going to a bakery that only sells its bread at the end of the day for a set price. You place your order in the morning, but you don't pick it up or know the final cost until closing time. Buying an ETF is like going to a 24/7 supermarket where the price of bread might fluctuate slightly throughout the day. You can walk in at any time, see the price on the shelf, and buy it on the spot. Both get you bread, but the process and timing are completely different. This difference in trading is fundamental. Mutual funds are designed for long-term, set-it-and-forget-it investors who aren't concerned with day-to-day price swings. You decide to invest, you put your money in, and you let the fund manager do the work. ETFs, on the other hand, offer the same long-term benefits, but also cater to investors who might want to be a bit more hands-on or react to market movements more quickly. Neither approach is inherently better. They just serve different preferences and strategies. Understanding this is key to choosing the right vehicle for your money. Let's start with the pros of mutual funds. The biggest advantage is professional management. You have experts who are dedicating their full time to researching investments and managing the portfolio. For a beginner, this can be incredibly reassuring. Another pro is simplicity. You often set up automatic investments, where a certain amount of money is taken from your bank account each month and invested into the fund. This hands-off approach is great for building discipline and consistency. Plus, you can often start investing with a very small amount of money, making them highly accessible for people just starting out. However, mutual funds have some significant cons. The most notable one is cost. Because you're paying for that active management, mutual funds typically have higher fees known as expense ratios. These fees might seem small, maybe 1% or 2%, but over decades, they can eat away a huge chunk of your returns. Seriously, it can add up to tens or even hundreds of thousands of dollars over a lifetime. Another downside is the lack of trading flexibility we talked about. You can only buy or sell at the end-of-day price, which some investors find restrictive. Lastly, they can be less tax efficient because the fund managers buying and selling can create capital gains that get passed on to you, the investor, even if you didn't sell any shares yourself. Now for ETFs. A major pro for ETFs is their low cost. Since most ETFs passively track an index, they don't need expensive teams of analysts. This results in much lower expense ratios, often well below 0.10%. This cost saving is a massive advantage for long-term growth. Another huge pro is transparency and trading flexibility. You can see exactly what assets the ETF holds at any time, and you can trade it like a stock throughout the day at a known price. ETFs are also generally more tax efficient. The way they are structured results in fewer taxable capital gains distributions, leaving more money in your pocket to keep growing. But ETFs aren't perfect either. One potential con is the temptation to overtrade. Because they are so easy to buy and sell, some beginners might be tempted to treat them like stocks, trying to time the market by buying and selling frequently. This is usually a losing strategy and can rack up trading costs and taxes. Another thing to watch out for is the bid-ask spread. This is the small difference between the price you can buy an ETF for and the price you can sell it for. For very popular ETFs, this spread is tiny, but for less traded ones, it can be larger and act as a hidden cost. So, after all that, what's the right choice for a beginner? A mutual fund, an ETF, or a mix of both? Honestly, for most beginners in 2025, I would lean heavily towards starting with low-cost, broad market index ETFs. The reasons are simple and powerful. Lower fees, better tax efficiency, and greater transparency. The cost savings alone are a game changer. When you're just starting, every single dollar counts, and giving less of your money away in fees means more of it is working for you, compounding year after year. An S&P 500 ETF or a total stock market ETF is an incredible way to get instant diversification at a rock-bottom price. That being said, mutual funds still have their place. If the idea of managing anything yourself, even just buying an ETF, is overwhelming, a mutual fund can be a good entry point. The set-it-and-forget-it nature, especially with automatic investing, is a powerful tool for building good habits. Some actively managed mutual funds also have a history of outperforming their benchmark indexes, although it's very important to remember that past performance is not a guarantee of future results. Many, if not most, active funds fail to beat the market over the long run, especially after you account for their higher fees. So here's a practical approach. Why not consider both? You could use a low-cost index ETF as the core of your portfolio, your main foundational investment. This gives you that broad market exposure for a very low fee. Then, if you find a specific mutual fund with a strategy you believe in and a manager with a great long-term track record, you could allocate a smaller portion of your portfolio to it. This hybrid approach gives you the best of both worlds, the low-cost passive core from an ETF and the potential for active management from a mutual fund. It's a balanced way to start your journey. Ultimately, the most important thing is simply to start. Don't let the decision between a mutual fund and an ETF paralyze you. The difference between investing in a good low-cost ETF versus a good low-cost mutual fund is much smaller than the difference between investing and not investing at all. This information is for educational purposes only. I am not a financial advisor, and this is not financial advice. Before making any investment decisions, please do your own research and consider speaking with a qualified financial professional who can understand your personal situation. Now go out there and start building your wealth.